Welcome to the deep dive. Really glad you could join us today. We're going to really try and cut through all the noise from the market on July 2nd, 2025.
Yeah, there is quite a bit going on.
Definitely. Our mission, basically, is to take that financial data, the opening prices, closing prices, what the big institutional players were doing, those key technical levels, and make sense of it all.
Turn data into insight.
Exactly. So by the end of this, you'll have a clearer picture of what happened, why it mattered, and maybe what signals it's sending out.
And July 2nd really did send some signals. I think the main theme, the big takeaway, was this definite risk-off feeling in the air.
Risk-off meaning investors getting nervous.
Precisely. Moving away from riskier things like stocks. It basically stopped the market's recent climb dead in its tracks. We saw a lot of profit booking.
So selling to lock in gains.
Exactly, especially in financials and banking stocks, which had been, leading the charge upwards. Plus, there's this lingering uncertainty around the U.S.-India trade talks kind of hanging over everything.
Right, that makes sense. So investors were maybe getting a bit cautious.
Yeah, pulling back a bit, waiting for clearer skies.
Okay, let's unpack this then. So the market starts with this cautious vibe. What actually happened with the main benchmarks, the Nifty 50 and the Bank Nifty? Both ended down, right? What was the story there on July 2nd?
Well, the Nifty 50, it actually started the day with a little bit of optimism. It opened at 25,588.830, just a touch above the previous close.
Okay, a slightly positive start.
Yeah, and it even popped up briefly to an intraday high of 25,608.6. For a moment, you might have thought, okay, the rally's continuing.
But that sounds like maybe a bit of a head fake. What happened after that high point? What signaled the reversal?
That's exactly what it was, a classic failed opening auction. That initial strength just got smacked down pretty quickly.
Sellers jump in?
They did. It hit that high, ran into significant selling pressure, and couldn't hold above that 25,600 zone. That failure was really a key bearish signal.
Okay.
From there, it was pretty much downhill. It broke below the psychological 25,500 mark.
Always an important level to watch.
Definitely. And it slid all the way down to an intraday low of 25,378.75.
So after that initial pop and drop, where did the Nifty end up at the close?
It finished the day at 25,453.40. That was a loss of about 88 points, or 0.35%.
And closing near the low.
Yeah, pretty close to the day's low. That's quite telling, right? It shows sellers were basically in control right through to the closing bell. The underlying pressure was just too strong despite that early flicker of hope.
Okay, so the Nifty reversal set a negative tone. But you mentioned the Bank Nifty really amplified things. It was the main drag.
Absolutely. The Bank Nifty was the principal underperformer that day, really the main catalyst for the broader market drop. It opened around 57,558 and briefly touched 57,628.
Similar start to the Nifty then.
Very similar. But then it just got hit by intense, sustained selling. It really dragged the whole market down with it, hitting an intraday low of 56,833.80.
Wow. And the damage at the close for the banks?
It closed at 56,999.20. That's a pretty substantial loss, 460 points, or 0.80%. We're using that figure. Seems the most reliable, despite a tiny difference in some feeds.
And the reason for such weakness there? Just profit-taking after the run-up?
That was a big part of it, yeah. Broad-based profit booking after hitting those all-time highs. But there was a specific trigger, too. Goldman Sachs downgraded Indus Bank to sell. That acted as a pretty powerful immediate catalyst for more selling in the sector.
A downgrade from a major player like Goldman, that'll do it.
Yeah, and you saw other heavyweights like HDFC Bank, even L&T, which is sometimes seen as a proxy for financials, also among the top Nifty losers. So it pointed to a wider cooling off in the financial space.
Okay, that makes sense. So if we zoom out a bit from just the index levels, what about the market's internal health, like the VIX, the fear gauge, and market breadth?
Right, connecting it to the bigger picture. It's actually quite fascinating. Let's start with the India VIX.
Yeah, the VIX. Given the market fell, you'd expect fear to rise, maybe? What did it do?
Well, that's the interesting part. The VIX opened at 12.45. It wiggled around a bit during the day, high of 12.66, low of 12.34, but it closed right back where it started, 12.45.
So basically flat. A slight dip even from the previous close.
Exactly, down just 0.65% from the previous close of 12.53. And the key thing is, it stayed comfortably below that psychological 15 level.
Which suggests?
It suggests that even though the market was correcting, there wasn't widespread panic. A VIX below 15 generally points to a more rational environment.
So the market went down, but the fear gauge didn't really spike.
Precisely. That divergence suggests it was more of a controlled pullback, maybe orderly profit-taking or rebalancing rather than panic selling. It implies there might still be some underlying support, that fear hasn't really gripped the market yet.
Okay, so not panic, maybe more of a strategic adjustment. What about market breadth, the advanced decline ratio? Did that show the selling was widespread?
Oh, absolutely. It was unequivocally negative. Market breadth tells you how many stocks are going up versus down. And the picture wasn't pretty. We saw only 975 gainers compared to 1,447 losers on the NSE.
So significantly more losers.
Yeah, the ratio works out to about 0.67. Anything below 1 is bearish. So for every, say, 2 stocks that went up, nearly 3 went down.
And within the Nifty 50 itself.
Similar story. 28 stocks ended in the red versus only 22 gainers.
That definitely sounds like the selling wasn't just a few big names pulling the index down. It was broad.
Exactly. That negative breadth proves the selling had significant depth. It wasn't isolated. And that kind of makes a quick, sharp V-shaped bounce back less likely. It reinforces this idea of the market perhaps needing to consolidate or take a breather.
Right. Yeah, this is where it gets really interesting for me, understanding what the big players, the institutional investors, were doing, FIIs and DIIs. But the data for July 2nd itself wasn't out yet when this report came together, correct?
That's right. The provisional data, the first estimate, wasn't available at the time. So to get a sense of the institutional mood leading into July 2nd, we have to look at the confirmed data from the day before, July 1st. Their actions often set the tone.
Okay, so what did July 1st show? Were the foreign institutions selling or were the domestic ones buying? What was the flow?
On July 1st, the FII's foreign institutional investors were pretty significant net sellers. They sold equities worth 1,970.14 crore. That's a chunky number.
Nearly 2,000 crores sold by FIs.
Yeah. And FII selling is often watched closely. On the other hand, the DII's domestic institutional investors, like our mutual funds, insurance companies, they actually stepped in and bought. They made net purchases of 771.08 crore.
So DIIs were trying to absorb some of that FII selling pressure. What was the net effect then? Did that big FII selling on Monday contribute to the weakness we saw on Tuesday, July 2nd?
Absolutely. That large net outflow from FIIs on July 1st really set a bearish precedent. It created what traders call a supply overhang, basically, a pool of shares ready to be sold. This definitely contributed to the cautious sentiment and the aggressive profit booking we saw on July 2nd. The DII buying was supportive, sure, but it just wasn't enough to soak up all that FII selling. It weakened the market setup going into Tuesday's session.
So the stage was kind of set for caution.
Pretty much, yeah.
Okay, this leads nicely into the technical picture. How did those pre-calculated technical levels, like support and resistance, play out on July 2nd? Did the market respect those levels?
It's actually quite remarkable how often it does. These levels, often based on things like Fibonacci retracements or pivot points, act like invisible guideposts for traders.
Right.
And on July 2nd, the price action stuck pretty closely to the key Fibonacci levels identified beforehand. Let's look at the Nifty 50 first.
Okay, so what were the key levels for the Nifty going into the day? Where was resistance and support expected? Resistance, this sort of ceiling, was predicted in the zone around 25,669. That's a 78.6% Fibonacci level, up to about 25,829. Support, the floor, was seen as crucial around 25,437, which was the S1 pivot point, with a more significant band maybe between 25,259 and 25,200.
And how did the Nifty actually trade relative to those?
It played out very neatly, actually. The day's high, remember, was 25,608.2.
Yeah.
That got stopped just below that resistance cluster identified around 25,633 to 25,669. So it validated that resistance zone. Then on the way down, it tested that S1 support around 25,437. The low dipped slightly below it to 25,378, but it managed to close just above S1.
Wow, the Bank Nifty's interaction was also telling, but in a more negative way. Its key resistance was identified up around 57,920, another 78.6% fib level, with other points near 57,794 and 58,041. Support was mapped at 57,150 near S1, then 56,878 S2, and lower down at 56,518.
And did it hold its support like the Nifty did?
No, and that's the crucial difference. It showed much more weakness. It failed way short of its resistance levels. The sell-off was so sharp, it just sliced right through its first support level, S1, around 57,132.
It broke S1.
Yes. And the day's low, 56,833.80, ended up being remarkably close to the second support level, the S2 pivot, at 56,878.
So Nifty tested its first support, but Bank Nifty broke right through its first support and almost hit the second one? That's a big divergence, isn't it?
Exactly. That's the key takeaway, technically. Breaking S1 is a much stronger bearish signal than just testing it. It showed the selling pressure in banking was far more intense, far more aggressive, which explains why it was the main laggard dragging the market down. A real breakdown of conviction in that sector.
Got it. Okay, so let's bring this down to the individual stock level. What was happening in the futures and options, the F&O segment? Even on a down day, there must have been some stocks that did well, right? Who are the top gainers?
Oh, yeah, absolutely. There are always outliers, usually driven by specific news. HDB Financial Services, HDBFS, was a big one. It surged 13.64%.
Wow, over 13%. What was the driver?
Brokerage coverage. MK Global initiated coverage with a buyer rating, suggesting something like a 22% potential upside. That kind of news can really move a stock.
Definitely a strong catalyst. Any others that stood out?
Tata Communications did well, rallying 4.73%. That seemed to be linked to a positive report from Macquarie. They suggested the stock could potentially double over 3 years because of improvements expected from its digital acquisitions.
So a positive long-term outlook driving it.
And Mankind Pharma gained 4.27%. That seemed to be part of a broader sort of selective interest in pharma and healthcare stocks, plus maybe some strength in mid-caps generally. Shows investors looking for defensive pockets, perhaps.
Right, so company news and maybe some sector rotation helping those stocks swim against the tide. Now, on the flip side, who were the notable losers? Which stocks really reflected that bearish mood?
Well, Hyundai Motor India took a big hit, plummeting over 5.22%.
Over 5% down. Why? Did they have bad sales numbers?
Actually, their monthly sales showed a marginal increase, but clearly the market was either expecting much more or perhaps more worried about the future demand outlook for cars, maybe seeing signs of a slowdown ahead.
Interesting. Disappointment despite a small rise. And we saw a couple of the nifty losers earlier, right?
Yes, exactly. Shriram Finance fell 2.85%, making it one of the top Nifty 50 losers. That looked like continued profit booking after it had run up quite strongly, just investors cashing in chips amid the caution.
Classic risk-off move.
Yep. And then IndusInd Bank, down 2.54%. As we mentioned, that was almost directly tied to that Goldman Sachs downgrade to sell, predicting a 15% downside. Shows the power of those analyst calls sometimes.
Yeah, absolutely. A direct hit from that news.
So pulling it all together, July 2nd was really a convergence of factors, wasn't it? You had that FII selling from the day before, setting a weak tone.
Creating that supply overhang you mentioned.
Exactly. Then add in the cautious global cues, like the U.S.-India trade uncertainty. So when the market opened, it ran into selling, especially in those financials that had done so well, and they became the main drag.
And it wasn't just a few stocks feeling the pain. The breadth showed it was widespread.
Confirmed by that negative advance decline ratio. It proved the selling had real depth. The only sort of counterpoint was the VIX staying calm.
Right, the lack of panic.
Yeah, suggesting it was more of an orderly correction, probably profit-taking, not a fear-driven route, a controlled pullback.
You know, it really feels like a shift from that buy every dip mindset we saw for a while towards maybe a more cautious sell the rally or just a consolidation phase. And we saw that hint of rotation too, right? Towards defensive sectors like metals, Tata Steel, GSW Steel were nifty gainers.
That's right. Money looking for a safer harbor, perhaps.
So looking ahead from here, what does this tell you? For the Nifty, that 25,300 to 25,400 zone seems pretty critical now as support, doesn't it?
It absolutely does. If it breaks below that, convincingly, we could see a deeper slide towards, say, 25,200. On the flip side, that 25,600 level is now confirmed as pretty solid resistance.
So the market's kind of caught between their levels for now.
Seems like it. The next big move will probably depend on, well, the upcoming Q1 earnings season results and any real news, positive or negative, on the U.S.-India trade situation.
Right. So given this environment, this shift maybe, how might you, our listener, think about processing market news now? Perhaps focusing less on just the headline index move and more on why things are moving, the catalysts, the sector shifts. What will you be watching for next?